Hi, everyone. Welcome and thank you for joining today's panel titled The Sub-Saharan African Housing Conundrum and Corresponding Opportunities. My name is Alexander Tunkara, and I'll be your moderator today. The goal of today's panel is to provide you all with an overview of the sub-Saharan housing landscape, highlighting its needs, the challenges faced in addressing those needs, and the various opportunities willing and able to take on and overcome those challenges. With me today, we have the renowned Dr. Marya Hooksmith, founder and director of the International Housing Financing Program, founder and executive director of the Housing Finance Information Network, known as HOFINET, and a frequent advisor to private and public sector clients in emerging markets and developing countries in the field of housing and housing finance policy, institutional development, and product development. We also have Mr. Kojo Adokufur, executive head of the home loan business at First National Bank Ghana. In 2006, he co-founded and served as executive director of Ghana Home Loans, a mortgage specialist which went on to become the leading provider of residential mortgages in Ghana. Next, we have Mr. Amit Dhillon, serial entrepreneur and managing director of U.S. Africa Housing Finance, also known as USAHF, an innovative mortgage financing solution for the Ghanaian market. And last but not least, we have Mr. Robert Hornsby, co-founder and acting CFO of American Home Builders of West Africa, the current lowest priced residential housing provider in the Ghanaian market. So thank you all for joining. And to kick things off, I'll start off with a question for you, Marya. In your illustrious career, you've completed consulting work for clients such as the World Bank, IMF, UN Habitat. The geographic footprint of those projects spans North America, Asia, and Latin America. With such a global perspective, could you share your view on the main challenges and opportunities present in the sub-Saharan housing market?
So thank you very much for inviting me here to your panel. I will begin talking about opportunities. I think that's the better way than starting with the challenges. But the challenges are big. So the opportunities are enormous in sub-Saharan Africa housing front. Africa is the least urbanized continent that we have, only 40% urban, and urbanizing at a fast pace. Per year, we need about 28 million we have coming in the cities, natural growth, and through my 28 million new urban dwellers. So if you translate that in the need for housing, that's enormous. So there is nearly an infinite need for housing. So that is the good part. Also, housing is an enormously important part of the GDP of a country. We have calculated that it is roughly 16% of the GDP of a country. If you include all the informal housing and extensions that are going on. So it is a critical part of the economy. Also, it can be used as a stimulus for economic recovery like we now have, because it generates employment in a sector of the labor market that is very elastic, as we call it, like unskilled labor that can be actually employed very rapidly. So big part of the economy, big demand, and at the moment, a macroeconomic environment that doesn't that is helpful for the housing sector, fairly stable, even though we have this enormous economic crisis. Now, what are the challenges to actually get that demand translated into housing? One of the biggest challenges actually is the lack of access to housing finance. No developer can come into this market if he cannot offload his stock and people can pay for it at the end. It is that simple. So if you don't have housing loans, we cannot scale up as developers. Why is that housing finance sector so small? Of course, very low income relative to prices of the houses, but also most of the income in sub-Saharan Africa is in the informal sector. And that makes it very hard for lenders to really build up their portfolio, because the central banks will not look at you favorably if you make risky loans. And loans to informally employed are penalized by the central banks. So that's a big challenge that has to be addressed. The second, of course, major challenge is that poverty at the moment is increasing at a rapid pace because of COVID and the economic crisis. So that makes affordability even more of a challenge. So I think those challenges have to be addressed, but we have very innovative, as my private sector colleagues will no doubt talk about, very innovative challenges that can address both the affordability issue and the informality of incomes. Thanks, Alex.
Of course, Maria, to quickly follow up on that, if one was to prioritize either reducing the price point, so to speak, to make the affordability issue less significant, or adversely look to focus on providing, which one would you say would have the largest scale impact in the near term?
The financing part has to come first, because without finance, I can have cheap housing, but I still can't pay for them. So finance for me, and that is why I have drifted, in the course of my career, more and more towards finding what you can do to that housing finance piece. And you need a lot of different types of finance, not just mortgage. You need microfinance. You need non-secured consumer finance for housing. So that picture, but that finance problem has to be addressed first. Yeah.
Yeah, Alex, I often think of it as I tell people to do a thought experiment. If you had to buy your own home today, if you're living in the US or Europe or wherever, without any financing, no mortgage available at all, I mean, what percentage of the audience here would be able to do that? I mean, my guess, I certainly wouldn't be able to. My guess would be very, very small. But that is the situation that people are dealing with in Africa today. We see it all the time, Bob and I, with our customers.
Thank you, Amit. Actually, this kind of transition might, I'm sorry, excuse me, go ahead, Maria.
No, it's an enormous issue. And in Africa, in low-income countries in general, the mortgage sector is only like 3% of GDP. And in well-developed economies, this is about 60, 70% or even higher. So we have tiny, tiny mortgage markets relative to the GDPs of countries. So we have to really work very hard on that.
I would almost say, Maria, in some cases in Africa, non-existent. I mean, tiny is probably not even the right word. They just don't even exist. I mean, Kojo will talk about Ghana. That's a little bit more, I mean, obviously quite a bit more advanced. But where Bob and I operate in Guinea or in parts of Francophone Africa, I think it's fair to say there is no mortgage market. It just doesn't exist.
Yeah, that's true. Yeah.
Great. Kojo, my next question will be addressed to you. You've done a phenomenal job addressing the mortgage finance deficit in Ghana. Can you tell us a little bit about your story and your experience, first with Ghana Home Loans and now with First National Bank?
So thanks a lot for the opportunity to participate on this platform. So let's Ghana Home Loans story, then I'll react to a couple of comments that have been made by my colleagues. So in 2004, a couple of colleagues and myself decided to attack home ownership, in response to some of the observations that have already been made. We drew inspiration from a company called SA Home Loans based in South Africa. They had done something similar in the SA market. So we decided to replicate that model here in Ghana. And at the time, Ghana was just coming into the middle income bracket. We had gone into the HIPIC program and a lot of debt forgiveness had being given to government. So, so the whole idea of Ghana transitioning into middle income was very consistent with this objective we had to set up a mortgage company. And after a couple of years of hard work, we managed to sign up as shareholders, Standard Bank of South Africa, FMO of the Netherlands, and we'll talk about them in a minute, and then a group called Broadcove Partners, kind of a small outfit based out of somewhere near Boston in the US. And then later, we signed up IFC as well as shareholders. And with a long-term funding of 30 million from OPIC of the US, Ghana Home Loans was born. And from 2006 to 2017, we did a very good job of trying to transform the mortgage market and bringing the product mainstream. I think by 2010, we were by far and away the largest provider of the product. And in 2016, what we did was to launch a $100 million medium-term note program on the local exchange. And the reason for that was we wanted to diversify away from DFI funding. Because between the OPIC facility we signed in 2006 and 2016, we signed facilities with FMO, IFC, Proparco, DEG, all the DFIs that operate in the local space. We were talking to raise medium to long-term funding, because you don't get that kind of funding in the local market. So in 2016, we raised a local alternative to this, which was the $100 million note program to fund our business. And the whole idea was that we issue notes under the program and we use it to write mortgages. A couple of things which are peculiar about our model. We raised funding in dollars and actually lend dollars into the local market. So when you take a facility from us, we give you the choice of borrowing either in cedis or dollars, but most of our clients tend to go for the dollar facility. And that's because of the cost of local currency. I mean, local currency has historically been quite high. To give you a sense of rates, if you borrow in dollars right now, if you take a mortgage in dollars right now, you're paying somewhere between 12.5%, 13% per annum. That sounds high. But when you take it in cedis, which is the local currency, you're probably paying early 20s. I mean, if you can think of paying a mortgage at 20%, you have a sense of what that does to the market. So most people foreign currency, which in itself presents the obvious challenges, which I'm sure are evident to anybody on this platform. So that's one of the things which are peculiar about the way we did it. And also we were able to structure it such that we provided people with an alternative, because before we came on the scene, the way you'd buy a house, if you were buying it, would be to make staged payments. I mean, if you're buying a house, say 100K, the vendor, the developer, will tell you to pay 30% upfront, another 30% in pretty much like a year's time, and then you pay another 30% and 10%. So maybe over a year or 2.5 years, you're supposed to pay for the entire house. And that's a big ask. And so most of the people who could afford this were those who were based outside the country. And so what we did was to make it possible for the local residents to be able to borrow on a long-term basis and acquire homes. I think it was Maria who said that the mortgage to GDP ratio is around 3%. In Ghana, it's even lower than that. In Ghana, we're still struggling to even hit the 1% point. And that's because when people think of home ownership, mortgages isn't the thing that comes to mind. I mean, most people build their homes, they don't buy. And to build a house, all you need to do is to find land from either the family or whoever's selling. And you tend to build at your own pace. So when you drive around Accra, you see a lot of houses under construction. Some of them quickly, some of them to pretty much literally take a lifetime to build. And that's how a good majority of people think of home ownership. And so when we came on the scene, we weren't only just providing a financing solution, we're also changing mindset. And that's even more difficult than getting people to borrow in dollars. And so as I said, we did that for the period from 2006 to 2017. Then we took a strategic decision with our other shareholders to convert to become a universal bank. So we changed from Ghana Home Loans to GHL Bank. So in addition to providing the mortgages, we provided a whole suite of universal banking products. And the reason for that was to deepen the relationship we have with our clients. Because in our old world, all they did from us was to take a mortgage loan, and they did all their banking elsewhere. And we tried to provide all their banking under one roof. And so that kicked off in 2017. And the next step after that was a merger with the local operations of First Rand Group, which is called First National Bank Ghana. That took place last year, 2020. So GHL Bank and First National Bank Ghana merged to create First National Bank. And so that's how we've been operating since. But real estate and mortgage finance is still very much in our DNA and still a significant portion of of what we do. So in a nutshell, that's been the story so far.
Thank you very much for that, Kojo. We have a lot of questions in the Q&A, but I'll make sure to address them at the end once we go through what we want to cover with the panel. Amit, to transition to you now, because similar to Ghana Home Loans, you are also making leeway in addressing the mortgage financing challenges, but specifically in Guinea. Can you tell us a little bit about how different your experiences are based on what you've just heard from Kojo, specifically given the impact DFI has had quite early on, and I understand that your business is completely privately financed without any of the DFI involvement?
Yeah, in fact, it's very interesting, Kojo, to hear you say. Can I actually ask you a question? And you'll understand why I'm asking. Roughly, how many loans do you have out in terms of dollars, like 100 million, 200 million? What's your outstanding loan balance, ballpark? And the reason why I'm asking this question is just to let you know. So U.S. Africa Housing Finance, we just hit the $2 million mark in terms of loan outstanding, and that's across 43 loans. I'm sure Kojo's answer is going to be much, much larger than that. Obviously, he's been in the marketplace for a lot longer, but I'm just trying to give you a sense of sort of the contrast. So Kojo, just ballpark, 100 million, 200 million, whatever the number,
it's closer to the 100 mark, 100 million US.
Okay, so let's assume $100 million. So I'm just trying to give people a sense of sort of what it looks like. So they've got roughly 100 million US dollars in outstanding loans in Ghana, which is, of course, for those of you that are familiar with Guinea, Conakry, it's not nearly as well developed a market. And Ghana, I think, arguably is one of the most well-developed markets in Africa. So we began, so Bob Hornsby, who's going to talk after me, the sort of the origin story of U.S. Africa Housing Finance. And I think the name kind of sums up what we do. So U.S. Africa Housing Finance. I'm an American company. I'm the managing director of it that provides housing finance in Africa. Specifically, as Alex mentioned, the country of Guinea Conakry, where Alex is from and knows very well. And the reason why I'm involved in this is because Bob Hornsby, my very good friend here, and I went to business school together at Wharton, UPenn, where Mario is a professor. Back in 2000, we graduated. And, so Bob and I are great friends. And one fine day, what was it, about 2015, I think, Bob calls me up and says, "Hey, Amit, there's this new venture I'm starting." And, Bob and I are very, very close friends. I'm like, "All right, Bob, now this I got to hear. What are you up to?" He says, "We're going to be building houses in Africa." I said, "Okay, great. Where in Africa?" He said, "In Guinea." I said, "Is that like Papua New Guinea? What are we talking about?" He's like, No, that's not even Africa. What are you talking about? So I had to go to Google Maps, looked it up, said, "Oh, okay, this is a Francophone country in West Africa, probably 3, 4, 5 countries away from Ghana." I didn't think anything of it. I said, "Okay, fine, Bob, you're one of my great friends. I trust you. I'll invest some of my personal capital in your new company called American Home Builders of West Africa." A couple of years went by. I didn't really think anything of it. I was just a passive investor. Bob would call me every once in a while and tell me, "Hey, this is happening, that's happening." But then we quickly realized that there was a problem. And that problem was that there was no way for American Home Builders of West Africa to grow in any significant way without housing finance, which is exactly to your point, Maria. And that's why I interjected to say, I asked myself at that point, I'm like, yeah, if I had to buy my house here in California without a housing finance, I couldn't do it. So how in the world are we going to sell these houses in Guinea? And so we brainstormed, Bob, myself, and his partner, Jonathan Halloran. And, we talked to some U.S. banks to see, well, okay, maybe we can get some American bank to help us with financing. They, of course, more or less laughed at us and said, "Are you kidding me? Oh, there's no way we'll give you financing for houses in a country we've never even heard of." So that was out. We said, "All right, let's try some NGOs." So we tried some, and they're like, "Yeah, this is interesting, but, if you need help with malaria vaccination or something, we can help you there, but not housing finance." So like, all right. We said, "All right, let's talk to some African banks." We talked to EcoBank. Didn't talk to you, Kojo, at Ghana Home Loans. Maybe that was a mistake. We might have gotten some. Yeah, we might have gotten a little bit better reception from you. But we talked to EcoBank and a few other folks, and they said, yeah, it's kind of interesting. Bottom line, they had no interest. So as I often like to say, necessity is the mother of invention. So we realized, and I personally realized, my investment in American Home Builders is going to go nowhere if we don't have housing finance. so Bob and I said, the guy said, well, pay me, why don't you run US Africa Housing, or why don't you run a company do housing finance, which, we named US Africa Housing Finance. And so that's where we started in 2017, March of 2017 to be precise. So coming up on 4 years that US Africa Housing Finance has been in existence. And so you can think of Bob's company, American Home Builders, it's a developer. They're actually building the houses. And you can think of my company, US Africa Housing Finance, as their exclusive housing finance partner. So essentially, American Home Builders sources the clients, obviously sells the client a home, and then basically we sort of jointly do the underwriting or agree to the underwriting, and then using private capital, purchase the home loan from American Home Builders. So essentially what I'm doing is I'm taking that off the developer's books. I'm taking the loan off the developer's books, and that gives me the right to the stream of payments from these loans. As I say, it's 43 loans in the portfolio right now. So every quarter I get the principal and interest payments from these 43 borrowers, and then I distribute out to my investors a certain return, which has been 9% annually for the last 4 years. So I'm providing a 9% return to my investors, and this is all U.S. dollar based. So Kojo, as you said, we certainly realized very early on that currency risk was certainly nothing we could even dream of dealing with. So all transactions are in U.S. dollars, and very similar to what you articulated, Kojo, we're focused right now exclusively on the diaspora market. So think of Ghanaian diaspora living in the US and mostly in Western Europe. So my entire portfolio of 43, roughly 75% are living in the United States, and the balance are in Western Europe, and actually recently a couple of loans in Australia as well. So we're certainly geographically spread out, reasonably well, but again, very focused on the diaspora. And the amazing thing is, over this 4-year period, when I got in, started running this thing, a couple of years ago, and I'm actually personally the second largest investor in the business. There's actually a private investor that's larger than me in terms of amount of capital put in, and I have 21 total, private investors, which are totaling that $2 million. But when we first started this, we had no idea what to expect. Right? We just didn't know, could we do this? Is this even possible? I mean, I'm a high-tech guy. I live here in Silicon Valley, right? I've been working in high-tech and networking and software my entire career. I'd never done anything in finance, but it just seemed like this has got to be doable. And so we just, perhaps, not knowing any better, sort of dove in head first. And the amazing thing to me over that 4-year period is we've had a sum total of 2 defaults. 2 defaults over a 4-year period, and neither of those defaults, but they were both, the houses were both resold, very quickly. There was no loss to the investors. In fact, a little bit to my surprise, although when I think about it now, it really shouldn't be very surprising. One of those houses that defaulted, I won't go through all the details, but the woman bought it in February, I think it was 2017. Defaulted like 9 months later. We resold it exactly 1 year later for 10% more than she had originally paid for it. And so that really sort of cushioned the blow of the default. And this shouldn't be very surprising because, as Maria pointed out, when you build a community, which is exactly what Bob's company is doing, they're building a housing community. As more and more houses get added in, naturally the prices start to rise. And I mention that because that is a sort of a hedge against default that I hadn't thought of originally. It wasn't something that would have occurred to me, but that's sort of become a natural hedge. And I think it's gotten to the point now where the portfolio is large enough that we require a 30% down, so we only finance 70%. And so we've gotten to the point now where the risk profile of this portfolio, and obviously as it grows larger, the risk goes down even more, is much, much lower than I personally could ever have imagined. The reason I say that is because, okay, defaults is one thing. We've had, 2 defaults. Okay, that's a pretty small number, compared to the overall loan size. Neither of those defaults had any material effect because the finance charges that were due were ultimately all paid back after the resale. So there was no negative effect. But perhaps more importantly than that is that the loan to value ratio of this portfolio is 60%, which means you can randomly pull any loan you want and it's 40% already paid off. And I would pose a question to everybody here. If you spent 40% of your hard-earned money already paying off a loan, are you going to very easily walk away from that? I mean, I think the obvious answer is no. So, you know, I'll sum it up because I could talk all day about this. I don't want to sort of keep going on, but the couple of lessons that I've learned here is that one is, despite the fact that we're talking about Africa and we're talking about loans to diasporans who, you know, are not at the top strata in terms of income, the default rates are amazingly low. And again, it comes down to a variety of things, including this LTV, but also just the fact that, think about it, these folks who have left the shores of Africa to come to a foreign land, they've dreamt their dream, their lifelong dream. We talk about the American dream. Their lifelong dream was to own a house back in the country of their birth. And as Kojo said, the vast majority of them never dreamed of buying that and financing that from somebody. They thought they were going to have to get their cousin, brother, uncle, whomever to help them build this house, you know, one room at a time over, who knows, a 10-year period. But suddenly they're able to, in sort of an American fashion, I'll call it, find an American designed house, buy it the same way they'd buy a house in Chicago or wherever, and then turn right around.
I mean, I hate to interrupt here, but in the essence of time, we do have to continue on, or we will not have any time for Q&A. Apologies.
Sure. Yeah. So I'll just say that you know the profile of this turned out to be, you know, so much more different than I could have ever have imagined.
Understood. Bob, you've been sitting there quite patiently and quietly. Well, this is your opportunity. Now, American Home Builders of West Africa has survived an Ebola outbreak, political upheaval, and even the loss of a co-founder, and yet continue to grow. What is your secret, specifically given that you operate in one of the toughest markets globally to achieve success in?
Thanks, Alex, and it hasn't required a lot of patience. It's been a real treat to listen to Kojo and Maria and Amit talk about their takes on this industry. I will say there's not necessarily any one secret special sauce. My partner Jonathan and I cut our teeth in West Africa as Peace Corps volunteers, and I think that gave us a certain appetite for taking on difficult challenges and understanding the context and knowing how to work around challenges. We have in some ways been, you could say that we followed the advice of Bruce Lee in our work in West Africa. He famously said, "Be like water. You know, when you encounter an obstacle, don't beat your head up against it. Find a way around it." And that's really how we've worked. We went into the business plan that we started with was designed around servicing local residents, local buyers in the local market. When we found out that the capacity to pay for the kinds of houses that we were able to build was just not there, and so we went to the diaspora. Well, we found a market in the diaspora, but we realized that market, even though they had more ability to pay than most local residents, they needed financing. And Amit told you the story about how we invented a solution to that problem based on our experience of knowing what it was on the ground. One thing that's been really critical to our continued survival and success, I'll say, is a real focus on understanding what customers want. I think where a lot of developers fall down in the residential market in the region is thinking that they can take a model that works in Europe or in North America or somewhere else and just come in and build to that model and expect that they'll just be able to turn around and sell things, or come in with certain kinds of technology solutions, modular products or whatever that that on paper look like a great idea, but for a variety of reasons, those things are not a fit for the local cultural context and what people want. And so we do a lot of talking with clients. We get a lot of feedback from clients. We don't typically build to spec. When we open a new development, we may put up one model home, but then subsequent iterations of that model are really designed on the fly, in a sense, as we incorporate client feedback to what we're doing. So really focusing on the customer, understanding what they want, and at the same time trying to bridge the gap between a dream and what they can actually afford. We often have people that have a sort of a $250,000 dream and a $50,000 budget, and you kind of have to find a way to walk that line and show them what's possible and give them a sense of how they can grow into that. The key constraint for us, I'll back up. I'll say another thing that has been really important for us in the way that we work, and particularly over the course of the past year, has been critical to our survival, is that we have from the beginning believed that the only way to build a business that can grow in the region is to build it with local labor, local management, and work with local subcontractors. So you'll see a lot of people that go into sub-Saharan Africa and build up local operations with lots of expat management, and even in the case of the Chinese, they'll bring in expat labor as well for a lot of projects. And our sense is that that's an expensive and actually ultimately a risky way to do business. You think about when we started during the Ebola outbreak, most expats left. Entire industry shut down in Guinea, Liberia, Sierra Leone because expat management got yanked out. Fast forward to the past year with the coronavirus pandemic, and people can't get in. Like, the travel restrictions have prevented us from being there the way that we normally would. Amit and I were there last in November 2019. Normally I would have been there several times between now and then. But because we invested in building up a local team that can manage that operation, and Alex, you've actually been there, you've seen these guys, they don't need us to stand over their shoulders. And I think people talk about the brand of Africa and risks of Africa, and sort of worry about can you rely on a local team. I would argue that you can. You just have to invest in building that team and building a culture there that brings everyone on board with the global mission of what you're trying to do. And once you do that, you actually have a lot less risk than you do when you follow these models of loading up your management with expats. And the last thing I'll say is that the big, these are things that have worked for us, and having this partnership with Amit and working together to set up this housing finance solution has been critical. Buyer financing remains the key constraint to our growth. And Amit can talk to you about some of the challenges in kind of telling that story to investors. But anybody that looks at housing and affordable housing in the region, if there were, for every 5 people that have some kind of technology solution to housing, whether it's modular or 3D printing or whatever, if there were one person that had a creative financing solution for every 5 people that have a creative technology solution, we don't, as Maria said, financing has to come first. Don't bring me 3D printed house. Don't bring me a modular house. Bring me 3D printed housing finance or modular housing. Bring me some kind of innovation that can remove that constraint, because the opportunity, as Maria said, is immense. And there are ways that you can do this. Amit is proof positive of that. Kojo is proof positive of that. You can do housing finance in this region. Is it easy? No. Do you have to be innovative? Yes, but the opportunity is there, the need is there, and if you're looking for a place to make a difference in thousands and millions of lives and have a really meaningful impact on the economy at a macro level, there's no better place to play than what we're doing. So.
Thank you, Bob, and very well said. With that, in the essence of time, we'll start opening up to Q&A. But first, I want to thank all of our panelists for sharing their amazing insights. I know that both myself and probably many of our audience members learned a lot today. So for the first question coming from Ira Green, this is direct towards Amit and Kojo. And Kojo, if you would like to answer the question first, how do you translate your business to a larger audience for affordable housing to urban lower and middle class citizens in Africa?
Right. So, I mean, we actually started off, the business plan looked at the non-resident population. That was the target. We thought they were the ones who were able to borrow in foreign currency and easily service foreign currency debt. And the expectation was that about 70% of the business will come from that segment and the rest will be local. In practice, what happened was it was the exact opposite. About 85%, 90% of our portfolio is resident Ghanaians and a smaller proportion offshore. Now that presents us with two kinds of problems. And I'll come to affordability in a minute. But the kind of problem it presents us with is you have local buyers borrowing in local currency, earning local currency and taking foreign currency facilities. And to give you a sense of what's happened to the city since we started, the city's gone from approximately 1-to-1 versus the dollar to currently 6 to the dollar. So think about that for a minute, from 1-to-1 to 6. And we've had clients who've been with us all the way through. Now, what we realized was that the local buyers, even though they earn local currency and are borrowing in foreign currency, with a bit of difficulty, they're still able to withstand the currency shocks. What we found with the non-resident market, and this is this came as a surprise to us, was that you find they are less likely to service their loans when there's a recession in the country they're in or whatever. Because no matter what they say, this is always going to be a second home as far as they're concerned. So when there are shocks to their income, the first thing they do is to stop making payments on the house in Ghana because they want to return to it one day, but they don't live there at the moment. And so that really forced us to take a long, hard look at the local market and try to make it work. And so we really then we had to encourage developers building in the affordable space. And to give you a sense of affordability, we think of affordability as anything between $30,000 and $70,000. That's about the price at which you get a decent house and a graduate or somebody, say, 3-4 years out of uni can at least have a good shot at buying. So we really had a long interaction with various developers to get them to come down the price curve into that zone, as opposed to the 100 and 200 and 300K kind of properties we were building prior. And that's the way we saw scale coming into the market. And that's the way we saw the kind of uplift we were looking for. I might just want to also throw into the equation the fact that, I mean, listening to Amit and Rob, I think I like their model better. We went 100% on the finance side because the view was that we focus on the finance and the developers develop and focus on the construction. But because of the absence of construction finance, lack of supply became a huge drag on the business. You start the year thinking you're going to finance 100 houses and then only 50 get developed. So now you're financing a fraction of your projection, and that didn't let us grow as quickly as we did. I mean, we did some really astonishing things, but it wasn't quite the volumes we're looking for because of the lack of construction finance. Kind of set up a construction wing to get some aspect of construction going, but that also presents us with another challenge, which is the developers then see you as competition, and then you get into all kinds of tough conversations with them. So there's so many moving parts. I'm sure we could spend a whole day talking about it. But the key thing is the local market is always the real market as far as we are concerned. And so the challenge has always been to find developers who are building in the right price range and give them all the support we can. And that includes bringing our funding partners. And we've worked with almost anybody who has any interest in housing finance, Shelter Freak, so many of them. We've brought them all to see the developers who develop in that price range so that they can bring out the critical volumes for us to be able to finance. And that's how we think scale can come to the market.
Interesting, Koja. Amit, it sounds here that Koja was actually able to achieve a lot of success in the local market. I understand that USAHF so far is diaspora focused, but to hear Kojo speak, the price point for affordability is also quite different in Ghana versus Guinea. Now, given that Guinea's price point for that affordable housing sector is so much lower, how do you anticipate that playing out into the growth of your business and the question previously asked, the expansion of access to capital?
Right. So again, in the interest of time, I won't go into great detail because, as Kojo said, we could talk for days about this. It's quite an interesting topic and certainly one close to my heart. But I'll try and summarize it with 2 points. So to the extent that someone decides, you know what, we want to have affordable housing successfully sold in an African country, be it Guinea or elsewhere. I think this applies across the country. Kojo, you can correct me if you think I'm wrong. There are 2 aspects. There is the price aspect, which I can't control as a finance guy, but Bob can. And I will tell you, I have loans on my books as we speak for houses that were sold at $25,000 US, to $25,000 US, which I think is very much in the quote affordability range. Obviously, that depends on who you are. So American Home Builders is working very, very diligently to meet that first criteria, price. And you know, if you talk to Bob and others, they have plans to go even below that. So that is a developer issue, one that they're tackling. On the finance side, I wholeheartedly agree that providing local financing is the holy grail. And that's where ultimately I would like to get with US Africa Housing Finance. But let me tell you, from where I stand right now, it is impossible for me to even dream about doing that without some very serious help from, let's call it government or quasi-government type of entities. So be that DFIs, local governments, IFC, you name it. I simply cannot do it. I cannot responsibly run US Africa Housing Finance as it's structured today with private capital here in the United States to try and hedge against local currency type of issues that I would run into in Guinea. Can't even dream of it. Which is, you know, why I'm on platforms like this and why I'm trying to talk to people is I'm trying to sort of shake the various DFIs and governments to wake up and say, look, here is an innovative bank financial institution that will grow this market. And I promise you I can grow this market, but I can't do it alone. I need them to step up and say, okay, we believe you. We've seen what you've done. You've seen your 4-year track record. Here's what we'll do. And you don't have to dump a bunch of money at me, but give me a facility to do that and the ability to hedge. Those are the 2 things, price and some I'll call it quasi-government help. Without those, you'll never reach affordable housing in Africa. It's not possible.
That's a very fair point there, Amit. That leads into our next question from Claude Mukunda. And apologies for those that this was running a little bit over. We just want to answer 2 to 3 more questions that some of the people had here. The first being, Maria, wonderful presentation. If finance is a precondition, what African governments should do to promote and support finance for affordable housing in Africa?
So a big policy is there. I agree with Amit. The government and the DFIs have to come in and do massive policy work and financing work in Africa, and they do. So the first thing, of course, is to deal with the credit risk, and the credit risk has 2 components. It is related to the land. You need collateral in order to make the loans cheap, to make a real mortgage loan. Mortgage loans are cheaper than consumer or microfinance loans. So you want cheap loans, then you have to create market. And for that mortgage market, you need land as collateral. So you need to develop your cadastre, you need to develop your property rights. At the moment, that is a very hopeful area. It has been a terrible area to work in, but at the moment we see in drone technology, we move away from plotting each plot, registering each plot in the old coordinate survey way. And we are seeing agreements in the central banks to allow the modern tech, to come to this market. So get land surveyed in a not so perfect way, so that at least it can serve as collateral for the loan, which makes lending a lot cheaper. That's one part. The other part, of course, of credit risk is the customer. I agree with default risk is not the biggest risk. But at the same time, to underwrite informal customers, and we have the informal sector in employment, in the labor market, in countries in West Africa, up to 60% of the labor force is informal. So if I create a mass market for accessing mortgage finance, I, as a private sector firm, to underwrite informally employed people. India has made enormous progress. None of that has happened yet in Africa. But when we look at the continent of equal income level and the facilitative role of the central bank and the liquidity facility for housing in India, they have made to allow the private sector to find ways to underwrite in a very creative way people that are informally using technology, using GIS systems. I can go on about that, but very innovative. The private sector in Africa hasn't even begun doing that. So those would be very critical parts. Then, of course, the private and public sector together have to develop information systems like credit bureaus, the underwriting and scoring models for credit risk, mortgage insurance, so that that credit risk piece becomes manageable. The second, apart from credit risk, the second other part is what Ghana has been doing and South Africa, and that is accessing capital markets to really expand the funding base for more and for microfinance as well. So how do we access capital markets? How can that be facilitated? The DFIs have started several liquidity facilities in Nigeria, in Kenya, in Egypt. So not very successful. I think the Ghanaian model is a lot more promising. You know, the securitization window that is different from just providing a refinancing possibility. But those, if you get a handle on the credit risk, both land and informal underwriting, as well as access to capital markets, that those mechanisms are needed to bring this sector to scale. And that's what we are all working on together, public and private.
Alex,
Understood. Robert, what are your
I just
views?
wanted to jump in briefly and say I'm glad Maria brought up underwriting, because this is sort of a huge part of what we do, and we hadn't spoken about it yet, but it's also one of those things where in our work with Amit, we essentially had to create a process for underwriting West Africans in the diaspora for home purchases in West Africa, because nobody was doing it. And that process spans people who are medical doctors and financial professionals and UN employees on one end, and what I would argue is something that looks like informal sector, in the sense that we have people who run their own hair braiding salons, and we have people who are Uber drivers, and coming up with a process for underwriting them. Some of these people are very well integrated into the financial system. Many of them are underbanked in a way that is consistent with how immigrant communities have been cut out of the financial system for ages, right? And so we have people come in we'll get credit scores for everybody that we can get credit scores for. But the credit score for us is a starting point of the discussion, not the be all and end all, because you might have somebody with an 800 credit score who's trying to buy a more house than they can afford. You might have someone with a 550 credit score who's got a low credit score because they've never had a credit card. They've never taken out a loan. They just have no history. And then you have to roll up your sleeves and really kind of understand what their financial situation is like. And this is one area for us, and Amit and I have been talking about this a lot. It's an area where we're planning to make some investments because it is a very labor-intensive process for us right now. People in the industry have told Amit that it's too strict a process because we don't have so many defaults.
That's right. Yeah.
But for us, you know, I think our goal here is different perhaps from some people that operate in the mortgage industry here. We want people in houses. We want to keep people in houses. We don't want defaults. If defaults are you know, yes, can we get through a default and not lose money? Yeah, but that's not why we're in this business, right? We want to make sure people can afford to buy these homes, but we do think there are more efficient ways that we can do that underwriting.
Bob, I don't know if we have time, but the EDPP program that we have set up, I think is very innovative from a underwriting perspective.
I'll just speak briefly to that. We sell houses three ways. Some people buy them in cash, just pay over the course of construction. Some people do financing through U.S. Africa Housing Finance, which goes up to 10 years. And then some people do a prepayment program where they can take up to 2 years to pay that 30% deposit and then roll into a finance purchase plan after that. And Amit loves those because when I go to Amit with somebody that's got an 18-month or 2-year history of making payments on a house that hasn't even started construction yet, and then I have, you know, the underwriting analysis and on top of the underwriting analysis, a payment history. He loves it, and it's just
frankly, I don't look at those loans twice because I've had multiple U.S. bankers in the United States tell me that, look, if you've got somebody that for 9 months, 12 months, 18 months has made a steady payment without even having a house, the likelihood that that person is going to default after they actually get the house is like near zero. You almost don't even need to qualify them any further. I mean, obviously we still do. We still look at everything, but that's very, very unique. Every banker I've ever talked to in the United States is like, that's fantastic. I wish we could do that. You know, they can't. We can. We're, you know, innovative private entity. And that's, I think, one of the many reasons why the default rate is so low because we're doing those kinds of things.
So actually, we got a similar product which we launched
Thank
about
you there for
3
me
years
for that
ago.
closing comment.
Now, I was going to say we have a similar product.
Excuse me,
which we
Kojo?
launched.
Could you repeat that?
I said we have a similar product to that which we launched about 3 years ago called Save to Own. So same thing. I mean, it's evidence-based credit. If somebody's able to, you set them a target and say, yes, you're in the informal sector, you might not have all the paperwork, but if you make a certain number of installments, that proves beyond any reasonable doubt that you can keep up with those payments over the period of the loan. The other thing we introduced was 100% mortgage, because for a lot of people interested in buying, they were struggling to get a down payment. So in conjunction with a group out in SA, we're able to provide insurance. So you take out a policy and then you borrow 70% of the loan, and the policy pays out if there's a default in the first 3 or 4 years. So that allows those with a down payment who don't have the down payment to acquire the property. So
yeah, I think that's a concept of private mortgage insurance here in the U.S. But yeah, similar concept. No, that makes a lot of sense, Kojo.
Yeah. All right, thank you guys. I'm gonna have to cut it for time here. What I will do, however, is give each of our panelists an opportunity to, within 2 to 3 sentences, say what their key takeaway they want to leave the audience with, and potentially talk about the next steps of their business. And if you're open to having anybody that was part of today's conference reach out, just kind of give you an opportunity to share what you want to share. And we'll start with you, Maria.
Key takeaway, a continent of enormous opportunity. It has to be broken open, and that requires indeed the collaboration of the private sector with its innovation and ways of doing things in a different way, but it also requires government regulations to facilitate the private sector to actually allow them to be innovative and not be penalized for it. That's my takeaway in 2 sentences.
Been very concise. Mr. Kojo.
Yeah, I think I'll second that. I mean, there's enormous opportunity here, and there's so many different of which we've discussed. And it's not just a housing problem. Somewhere in there, there's an infrastructure problem as well, providing the infrastructure that makes a lot of these affordable housing projects livable. Because normally when they talk affordable housing, it's somewhere out in some remote part without any access routes or any of the basic utilities. So it's a huge opportunity, lots of moving parts, and anybody who's interested in the real challenges, more than welcome to jump in. But the rewards are quite clear for everyone to see. Yeah. So 2 sentences.
Great rallying cry, Kojo. How about yourself, Robert?
Well, I can only echo what Maria and Kojo have said, and I'll just say, for people that are looking for economic returns, the impact, you're talking about a region where it's a young population, it's a fast-growing population, it's a fast-growing economic zone. Anybody that's looking for real opportunity should be looking at something here. Housing, I think, is great. There are many other sectors that are great too. And to those that are still sort of carrying around this burden of the notion that there's such a thing as Africa risk, I will say this to you: if you're investing in the U.S., don't come talk to me about Africa risk after last week.
Oh my goodness. Amit, I'll give you the final say.
All right, mine is simple. Mine is simple. Investors are welcome. I told you I'm at $2 million in outstanding loans. I'm going to get to 10 million quickly, and I'm heading to 100 million. I cannot do it alone. Anybody that wants to jump on board with us, come in, and I can promise you 3 things that you'll get. A great return. It's been 9% for the last 4 years. Relatively low risk. I would argue much lower risk than probably you're taking in the US markets today. 60% loan to value, as I mentioned. And third, which is, I almost hate to put this third, but I think it's almost the most important, is empirically obvious social impact. As Maria said earlier, you cannot build a community in a country with local labor and all the things that it involves without having positive social impact. Just, it can't happen. They go hand in glove. So if you're looking for a great social impact investment, gives you great returns with low risk, come my way.
Great. Thank you so much to our panelists and to everyone for attending today. If you want to have any follow-on conversations or want to set up any other time, please reach out to us directly or the Empower Africa team. And once again, thank you all for your time, and hopefully we can address the housing conundrum in sub-Saharan Africa as we move forward. Take care, everyone.
Thanks, Alex.
Thank you, Alex. Take care.
All right. Bye-bye.